5.48% JAAA or 4.2% SGOV. Which is better? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, or at least slightly better than I am, as you can hear from my slightly hoarse and stuffy voice. In any case, welcome back to our weekly update. So, after we published our recent videos about JAAA, Janus Henderson's AAA CLO ETF, linked below in the first pinned comment, we got quite a few member questions about how they should compare JAAA to another fund that's very popular amongst our super savers here, namely BlackRock's SGOV, the iShares 0 to 3 month treasury bond ETF. Now, JAAA and SGOV can look very similar in how they would fit into a diversified portfolio. Both are popular vehicles for safely parking cash while also generating an income stream that's paid out in monthly dividends. But, and here comes the key difference, JAAA has a track record of noticeably higher cash distributions and total returns. JAAA's trailing 12-month yield of 5.48% beats SGOV's 4.2% clearly. And the total returns of JAAA are also consistently higher, sometimes by as much as 2 percentage points, like here for the 3-year total return. 7.02% for JAAA versus only 4.88% for SGOV. And yes, these returns are after cost, meaning they already deduct the expenses for the asset manager, which are higher for JAAA at 20 basis points than for SGOV at 9 basis points. So, with that in mind, here are the 3 topics that we'll be covering today. 1. How are SGOV and JAAA similar? And how can JAAA deliver higher cash distribution yields and total returns? 2. How do current rates compare for treasuries, agencies, and annuities? This section will be particularly interesting for those of you who are looking to lock in the current rates for longer than what SGOV and JAAA can offer. And 3. What are the predicted yields for the upcoming week's treasury auctions? Let's dive in now, folks. How are SGOV and JAAA similar? And how can JAAA deliver higher cash distribution yields and total returns? As so often here at Diamond NestEgg, let's start our JAAA versus SGOV comparison with a table that gives you a good overview at a glance. Here we have the name of the ETF, its ticker symbol, and when it was established. In the next columns, we have the expense ratio, the portfolio quality by ratings, the AUM or assets under management, the price per share in dollars at the time of this taping, and the distribution yield. The cash payouts as a percentage of the latest share price, as measured by the trailing 12-month yield, or TTM, that Morningstar calculates for most funds. The TTM looks at how much the fund actually paid out to its shareholders in cash over the past 12 months and divides that by the last month's ending share price. And here you have the trailing total return that you would have made had you invested in a share 1, 3, and 5 years ago. The total return captures both the cash payouts and any capital gains or losses from share price movements, expressed as an annualized percentage. Remember that all these yield and return numbers are already net of this expense ratio. So, in the first line, we have the Janus Henderson AAA CLO ETF, JAAA. And in the second line, we have the iShares 0 to 3 month treasury bond ETF, SGOV. As we touched upon earlier, JAAA has delivered consistently higher returns than SGOV, no matter which time period we look at on this table. Before we dive into the reasons why, let's first take a look at the 5 similarities that SGOV and JAAA share. 1. Both funds are widely considered safe vehicles for parking cash. Neither the treasuries that SGOV holds in its portfolio, nor the AAA-rated tranches of the CLOs that JAAA holds have ever defaulted in living memory. And if you want to revisit CLOs, collateralized loan obligations, what they are and how they work, these recent CLO videos, linked below in the first pinned comment, should give you a good introduction. 2. JAAA and SGOV carry very similar credit ratings. as you can see here from this table. In fact, JAAA holds only AAA rated CLO tranches, which makes it technically even a bit safer than treasuries, which are now ranked one notch below that at AA plus or their equivalent by the three leading ratings agencies. Of course, the ratings for governments are usually a bit stricter than for private corporations, meaning that government bonds have overall mostly experienced lower historical default rates than corporate bonds with the same rating. 3. Both JAAA and SGOV are considered very liquid ETFs for most retail investor purposes. Both have multi-billion-dollar portfolios, $66.9 billion in assets for SGOV and $24.3 billion for JAAA, and both trade several million shares every day at bid-ask spreads in the low single basis points. 4. Both funds have returns and cash distributions that fluctuate with the Fed funds rate. SGOV because it only holds treasuries with a maturity below 3 months, and JAAA because its underlying corporate loans are floating rate, meaning they track an index that follows the Fed funds rate closely as well. Neither of these funds will lock in current yields, so if you fear that rates may come down some more in the near future and want to lock them in where they are now, then you'll need to invest in other types of safe investments, such as longer-term treasuries, agencies, or annuities. We'll be discussing these in the second part of today's video for those of you who fall into this boat. And as a reminder, because the rates are not locked in with either JAAA or SGOV, this means that neither fund can guarantee or promise a future payout that will resemble the latest trailing 12-month yields that we've shown you here. These numbers are based on historical performance. As an investor, you should expect that the actual cash distribution yield will look different going forward for both funds, depending on how the markets develop. 5. Both JAAA and SGOV were launched in 2020 and pay monthly dividends, as we've already touched upon. If we look at these 5 similarities here, what this tells us is that both JAAA and SGOV are considered as cash equivalents in most portfolios, meaning safe and liquid with some decent distribution yields. However, both will not deliver much, if any, capital growth. If you're looking for an investment that helps you grow your wealth faster, you may need to consider higher risk alternatives. But let's address the key question now. Where is the extra return that JAAA has delivered in the past coming from? Well, there are 5 main reasons for JAAA's higher returns over SGOV. First, and perhaps the most important point, the credit risk in the underlying portfolio. While neither treasuries nor AAA-rated CLO tranches have ever defaulted in living memory, as I said before, the corporate loans that are the basis for the CLOs are non-investment grade and neither insured nor guaranteed. If more of them default than calculated, there is the possibility that a really bad economy might eat into the AAA tranche of a CLO as well, so to speak. This risk has stayed purely theoretical for CLOs so far. Even during the internet bubble of 2000 and the great financial crisis of 2008-2009, no single AAA tranche of a CLO has ever defaulted, as we've discussed a number of times already on this channel. But if you're very conservative, nothing can beat the explicit backing, the full faith and credit of the United States government that treasuries enjoy. And you can see the difference in risk when you look at the portfolios. SGOV here holds only treasuries of a very short maturity in its portfolio. JAAA, on the other hand, owns AAA-rated tranches of a variety of different CLOs. If you look at the positions here, you'll find different CLOs, many of which are linked to private equity firms, such as KKR here, or other asset managers, such as Neuberger Berman. But what you cannot see is the names of the firms that are the ultimate debtors for your investment. And even if you could see them, you might not recognize many, as they're often smaller niche players of lesser credit quality. Which brings us to the next closely related risk. Second, the use of financial engineering. By design, CLOs employ a lot of financial engineering to structure their investments in a way that cuts a AAA-rated tranche or slice, out of a portfolio of non-investment grade corporate loans. Now, some people are skeptical of all products that employ financial engineering or structures and will just not invest in them as a matter of principle. If that's you, CLO ETFs such as JAAA are probably not for you, even if they can point to a very strong track record for their AAA slices. On the other hand, if you can get comfortable with CLOs and their AAA rated tranches, you still need to accept that there will always be a little bit of remaining risk in any structured product. For example, while the underlying portfolio of SGOV consists only of treasuries that are themselves very liquid, JAAA's underlying CLO tranches are much less easily traded. So if something were to go terribly wrong, the managers of JAAA might have a harder time doing something about it quickly in a crisis if they can't find a buyer for an acceptable price. Which brings us to the third point, the difference in management style. SGOV is passively managed, meaning the portfolio follows an underlying index as closely as possible. In contrast, JAAA is actively managed, which means its management will monitor the underlying risks and try to take mitigating and corrective actions as needed, for instance, by selling problematic exposures and replacing them with better new tranches. But of course, how effective these actions will be will depend on the skill and diligence of the portfolio managers. And for a retail investor, that can be something that's hard to judge from the outside. Fourth, share price volatility. So while all these risks here have not yet led to even a single default of a AAA rated tranche of a CLO at this point in time, they can sometimes be reflected in JAAA's price movements. In other words, JAAA has a slightly more volatile share price than SGOV, meaning that if you had to sell at the wrong moment, you could have a slight gain or loss versus your initial purchase price. You can see it on this chart here. Over the past 5 years, SGOV, the dark green line here, has been pretty stable. It never fell below its initial issue price and is in fact up 0.3% at the time of this taping. The light blue line for JAAA shows more volatility, however. Its share price fell below the initial value for a while in 2022-2023 when the Fed raised rates aggressively. But it also showed some gains more recently in a falling rate environment and is still up 1.7% versus its initial issue price. Do note that this chart may be a bit misleading though, because the scale is so small, it makes even tiny price movements look large. But these are not large gains or losses in absolute terms. We're speaking about a range of plus minus 2 to 2.5% here for the share price of JAAA over its lifetime. And that isn't so bad for an investment with a trailing 12-month yield of 5.4% at the time of this taping. The cash distributions provide a healthy cushion here. However, you should keep in mind that JAAA is not a money market fund, whose share price is always exactly $1, and even SGOV may fluctuate by a few cents per share. And the fifth point, tax treatment in normal taxable brokerage accounts. JAAA's dividends are fully taxable as ordinary income at the federal, state, and local levels because they derive ultimately from the interest paid on corporate loans. SGOV has an advantage here in comparison. Treasuries are taxable as ordinary income at the federal level, but exempt from state and local taxes, and this advantage is passed through to the investors in SGOV. So if you live in a high-tax state and you're trying to make the JAAA versus SGOV decision for your normal taxable brokerage account, you may want to run the after-tax numbers first to see what the yield difference might be in your concrete case. As I like to remind our Diamond NestEgg members regularly, Treasury yields continue to be higher now than where they have been on average over the past 2 decades, which is why SGOV's yield has also been fairly attractive. But as rates have moved lower this year, more and more of you are looking for other opportunities for income beyond what the likes of Treasuries and SGOV can deliver, which is what opens the doors for a AAA CLO ETF like JAAA, if you're willing and able to take on slightly more risk. So, if your goal for the new year is higher yields beyond T-bills, T-notes, and T-bonds, I'd like to invite you to join the waitlist for a brand new exclusive VIP member community where Marcus and I will be doing an entire income series in 2026 focused on topics like corporate bond investing, higher yielding bond funds, preferred shares, principal protected products, and more. This brand new private VIP member community is an upgrade and a replacement of our existing YouTube member zone. It will officially launch on January 15th, 2026. So, if income generation with a keen eye on safety is indeed top of mind for you, visit us at www.diamondnestegg.com and click on this yellow private VIP member community button to join our VIP member waitlist and be the first to grab our early bird discount before January 15th, 2026. For today, let's return to the safe income generation opportunity that you can get from JAAA and SGOV. Now that we've explained how the two ETFs are similar, as well as how JAAA delivers higher returns over SGOV, drop a comment below and let me, Marcus, and our Diamond NestEgg regulars know, do you like JAAA or SGOV, and why? And let's move on now to the next topic of today's discussion. For those of you in our community who are less focused on short-term yields and more on how to lock in the existing medium and long-term rates. How do current rates compare for treasuries, agencies, and annuities? As we normally do at the end of the week, let's compare the annuity, agency, and treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which is usually treasuries. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes on the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to treasuries and non-callable agencies in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that they don't pay interest regularly, but accumulate it in the account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs, which have moved a little bit since last week. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.25%. A $50,000 7-year MYGA might earn you 4.35%. A $100,000 7-year MYGA might earn you 4.5%. And a $1 million MYGA might earn you even 4.55% for 7 years. And if you have more than the amount shown here, say north of $10 million, your rate might go as high as 4.65% with this AA+ insurance carrier this coming week. So basically, 5 basis points lower this week than last week. In fact, the MYGA rates across the entire maturity spectrum shown on this table are 5 basis points lower this week than last week. Nonetheless, and as I repeat nearly every single week, because annuity rates track interest rates, they are still at above average levels when you compare them over the most recent 20-year period. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors, including how strongly or not so strongly the insurance company you're buying your annuity from is rated, meaning how risky or not risky your insurance company is. As I've already mentioned, it will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to non-callable agencies and treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. So, as this table shows, the rates on non-callable agency bonds range from as low as 3.51% for a 2-year term up to 3.98% for a 7-year term. and the rates on treasuries range from as low as 3.48% for a 2-year term up to 3.91% for a 7-year term, so a bit lower than last week overall. And what we continue to see here is that for a 2-year term and for amounts under $100,000, the rates for MYGAs, non-callable agencies, and treasuries continue to be fairly similar. So, as I've said before, if it were me, I would probably go with the 2-year T-note if this was my time horizon, given the small difference in yield and the generally higher liquidity of treasuries. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over non-callable agencies and treasuries, and more substantially so the further out you go and the more you invest. So, if you're comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Annuities come in many different flavors. MYGAs are more like CDs, whereas FIAs, fixed indexed annuities, allow for potentially higher market-based returns, tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these 2 recent videos on how to protect your money against a bubble, linked below in the first pinned comment. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at an attractive 9.25% at the time of this taping. For a 7-year cap that stays the same for the life of the FIA, that number also continues to be worth a look at 7.25%. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLACs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below in the first pinned comment, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or shoot us an email at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialist to see what your options may be, because there's no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Moving on now to our usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields were mostly down, as you can see from all the red here, albeit only by a few basis points. It seems no one was quite sure what to make of the better-than-expected inflation report that was released earlier in the week, showing that annual inflation was down to 2.7% for November from 3% in September before the shutdown happened. But drop a comment below and let everyone know, where do you think Treasury yields may go next? Curious minds want to know what the mood amongst our Diamond NestEgg regulars is. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. And again, increases in rates are shown in black and decreases in rates are shown in red. And not surprisingly, after a more or less quiet week, the overall picture hasn't really changed here either. The 30-year is still yielding just a few basis points more than at the beginning of the year. And while we still have a yield dip, lower yields for the middle maturities, the yield curve overall remains much steeper than where we started the year at, meaning the premium you earn for lending out your money to the government for longer is now higher. And this is true regardless of whether we're looking at the 2-year versus the 10-year or the 1-month versus the 30-year comparison. As I've said often, no one can predict with 100% certainty how rates will develop going forward. But if you can live with the uncertainty and think that long-term yields may be coming down again, then it might still be a good time to buy some longer maturities to lock the rates in, or to simply add some longer maturity treasuries, agencies, annuities, or other bonds to your portfolio as you continue to dollar cost average. It really all depends on your personal outlook, but as I mentioned earlier, our current rates are still quite attractive if we compare them to the average yields over the past 20 years. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where Treasury, agency, and annuity rates ended the week, let's move on to the next part of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. The 52-week T-bill will also be auctioned off this coming week. And if we scroll down, we can see that the 2-year T-note, the 5-year T-note, and the 7-year T-note auctions are also on the schedule. None of these are reopening auctions. There's also a 2-year floating rate note reopening auction happening 2 days before Christmas. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.62, the 13-week at 3.554, the 26-week at 3.597, and the 52-week at 3.501. For the 2-year T-note, the expected coupon is 3.375, and the expected yield is 3.474. For the 5-year T-note, the expected coupon is 3.625, and the expected yield is 3.702. And for the 7-year T-note, the expected coupon is 3.75, and the expected yield is 3.905. Please keep in mind that all of these rates can and usually do change all the way up to the time of the auction. If, on the other hand, you're interested in the higher annuity rates that we've shared with you in this table, drop us a note at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. And again, if you are interested in learning more about safe ways to generate additional income in 2026 beyond what treasuries can pay, either via corporate bonds, higher yielding bond funds, preferred shares, or other investment vehicles, do visit us at www.diamondnestegg.com and click on this yellow private VIP member community button to join our VIP member waitlist and be the first to grab our early bird discount before January 15th, 2026. All right, member super savers and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.